Hello and welcome to the Money Compass.
In each episode, we will be preparing you for your journey through the world of finance and helping you tick off the destinations on your financial itinerary.
Pack your bags and prepare for takeoff as you navigate your way to financial success.
Are you up to anything nice this weekend then, Becky?
Well, we are having our new living room furniture delivered.
Ooh, how long have you been waiting for that for?
Oh, it feels like ages, but it probably only feels like ages because I've been counting down the weeks until it arrives, and it's finally here.
Way! Congratulations.
I know.
What have you treated yourself to then?
Well, at the minute we've got two-seater sofas, so we've changed. So we now have one big sofa and a chair.
Oh, very fancy.
I'm quite excited. So our project for this evening is to move the room around in preparation. So
exciting stuff.
I'm very excited. So watch this space.
Does that mean that Matt gets the sofa and he can stretch out and lay down, and then you've got the little chair in the corner?
No, not quite.
Make sure it doesn't happen, Becky. Make sure.
Yes, I'll stand my ground. So, well, it can't be any worse than his seat on the current sofas that we have, which is basically when you sit on it, you fall through it.
Wow. I think he's been sat there far too long.
Yeah, a bit of a couch potato maybe, but it's you do fall through the sofas that we have. So it's time that they were changed.
Fair enough. Well, I hope they're lovely when they come. I'll have to come round and have a test of them.
You will, yes. So, yes, I'm very excited.
Sounds good to me. So, we're talking today about how safe is your bank, which is quite interesting because some people would think, well, of course it's safe. It's my bank. Why wouldn't it be? But
it almost sounds a bit like a trick question.
I promise you it's not. But there's a few different things to look at when we're thinking about how safe your bank is. So, when you think about cash, there's no investment risk. So in loads of episodes previously, you know, Becky, we've talked about how money can go up and down in value because of the shares that it's invested in. But that's not a problem with your cash because once you put it in there, it remains as cash. You don't invest it into any different assets. But there are still some risks. So the first one of those is inflation risk. So we've probably mentioned this before in previous episodes as well. But Becky, do you want to just give us a reminder? Tell us what inflation risk is.
Well, inflation risk in relation to a bank account would be if the rate of inflation is higher than the interest that you're earning. So, Emma, just to refresh my memory, what is the current rate of inflation?
So inflation at the moment is 2.1% and Bank of England base rate is currently 0.1%. So inflation is currently 2% higher than what you're earning in the bank. So imagine you've got £100,000 in the bank. Actually, the buying power of that in, say, a year's time is going to be £98,000. So it'll be £2,000 less than it is at the moment.
Yeah, so interesting stat here. When I was looking into this episode, did you know in 1960 you could buy a loaf of sliced bread, no less, for 5p?
Wow.
So because of the effects of inflation, today you would be looking between 60p and £1.20 for the same sliced loaf of bread. So you can see that your same £1, for example, 60 years ago would have bought you lots of loaves of bread.
More bread than you know what to do with.
Exactly. But today, where the inflation has sort of eaten away at the value of that pound would mean that you would buy less bread in this example, or less of anything else that will have had the same, inflation will have had the same effect on it.
Yeah, and I think it's important to remember as well that the value of some things goes up by more than inflation. So
yes.
Prices of cars and things like that, they don't just go up by the normal amount. If you looked at that kind of as an example, you're talking tens of percent more sometimes rather than just 2% of inflation. So.
Look at houses lately as well. They've shot right up.
Yeah, definitely.
So
I read something the other day. They're going up by about £20,000 a month.
Ah, that's ridiculous. That's scary.
How can you even keep up with that?
Definitely not if you're saving in a bank account at the minute.
Definitely not. So another risk of a bank account is a risk of default. So when we say that, what we're talking about is if your bank were to go bust. Now, it's not something that happens very often, but it's a possibility. A lot of us only think of the big high street banks, so your Lloyds, your Barclays, those sorts of places. But there are lots of smaller challenger banks which it could happen with. So again, we've mentioned previously the FSCS, also known as the Financial Services Compensation Scheme, and they've been set up to protect you if a bank were to go bust, basically. So, Becky, are you going to tell us some more about the FSCS as well and what they do?
I certainly can do. So if you hold money in a UK authorised bank, so this is, like you were saying, your Lloyds, your Halifaxes, basically anyone that's registered or regulated even by the FCA, if the firm fails or goes bust, however you want to say it, and it happens after the 1st of January 2017, which it would do because we're now in 2021, you would be eligible to receive back up to £85,000 per eligible person per bank or building society. And that £85,000 is actually increased to £170,000 where you've got a joint account. So, for example, if you have £40,000 in an ABC bank account and they go out of business, you would potentially be able to receive back your full £40,000 via the FSCS. So that all sounds good. If you had £100,000 in the same ABC bank account, you would only be able to reclaim £85,000 of the £100,000 because £85,000 is the maximum limit per bank account, per bank, per person.
Bit of a mouthful.
That was a little bit, sorry there.
It's all right. I think it's important as well to remember that you wouldn't get the 85,000 plus 170 for a joint account. It's either or.
Yes. Sorry, I didn't make that clear at all, did I?
So if you've got a joint account, you'd be covered for up to 170,000 in the joint account, but half of that is your kind of own 85,000.
Your allowance.
So just take note of that. You can't have 170 in a joint account and be protected and 85 in the same bank in your own name, and you wouldn't be covered for both.
Yes. So the other thing to think about going off of what you've just said, Emma, is if you do have large amounts of money in bank accounts, it's worth splitting the money across a number of different banks. And when you do this, make sure that they're not part of the same group, or I think it's part of the same banking licence, because you're only allowed up to £85,000 per banking licence. So, for example, if you had £85,000 with Halifax and £85,000 with Bank of Scotland, because both banks come under the same licence, you would actually only get one £85,000 back. Whereas if you had 85 with Halifax and 85 with, let's say, HSBC, you could potentially get two lots of £85,000 back.
Definitely. I remember that from when I was at Norwich and Peterborough Building Society, and people didn't used to realise that because we were part of a bigger group, and there was Yorkshire Building Society, Norwich and Peterborough Building Society, Chelsea,
yes,
Egg, and Accord possibly, all in the same group.
Yeah.
So if you, obviously they don't have the same name, they don't even sound associated, so it is definitely worth checking in all the paperwork where you are covered.
Yeah, who comes under the same group as the bank that you're with.
Definitely. Where did the FSCS come about, Becky, and why did they kind of get created?
It has been about for a fair few years now, but I think most recently the limits have been increased since the financial crisis in 2007-2008.
Right. Which was when something happened to Northern Rock, wasn't it?
Yes, so many of you may remember Northern Rock.
To be honest, I'm actually going to say I don't really remember this. I think I was a little bit too young still, but I'm going to take that like with a badge of honour that I'm young enough.
Take that as a compliment, I
Definitely.
think, as a good thing.
So what actually happened in 2007-2008, Becky, to Northern Rock?
So normally, and I think we have touched on this before, when banks offer loans and mortgages to their customers, they usually use other customers' money, basically, to fund the loans. And I'm fairly sure we have mentioned that in another episode.
Yeah.
So this is why sometimes your fixed term or limited access accounts have a higher rate of interest, because the bank behind the scenes will be using that money that you've deposited with them to lend out to other savers, borrowers, whoever they may be. And when you then need your money back, that then gives them, let's say, 30 days to get the money, to raise the money from elsewhere, so they can then give it back to you. And in return, that's what gives you your higher rate of interest.
Mm-hmm.
So in simple terms, in 2007, Northern Rock had started to borrow the money that they were lending out from international money markets, which was a great idea until 2007 and 2008 happened and the market completely imploded and they couldn't get any money from anywhere.
So instead of using savers' money, they were going elsewhere to find the money.
Exactly.
To give out to borrowers, because obviously they wanted to lend more than they actually had. Exactly. At the time, Northern Rock went to the Bank of England and they did agree some emergency funding, and that meant that they could give the savers back their money. And the UK government also agreed to basically guarantee any deposits that had been saved with Northern Rock. So basically the Bank of England and the UK government said no savers will lose out because of what Northern Rock had done. And I think they did that as well, didn't they? Because of the panic, there were queues and queues at the doors of the bank of people wanting all their money out, because obviously they heard that their bank was about to go bust because they didn't have the money to be able to give it back. So people were going in to get out what they could to kind of save what they could, because they didn't know at the time what they were going to get.
Exactly. Yeah. So they were bailed out by the government.
I see.
So that stopped them losing all of the money that they had. So at the time, the FSCS, going back round to the FSCS, only guaranteed protection for 100% of the first £2,000 of savings and 90% of the next £33,000.
Wow.
So
that's a lot less than the 85
that is
there is now.
A lot less. So I suspect that what happened with Northern Rock had something to do with the limit being increased to where it is today. So that actually meant, when you add those figures together, that only the first £31,700 of a saver's money was protected by the FSCS.
So considerably less than
less than £85,000.
So the FSCS, do they just cover bank accounts or do they cover anything else as well?
No, so I know we've talked mainly about bank accounts today, but the FSCS covers most things financial, regulated financial, may I add. Mm-hmm. So for investments, you're also covered by the FSCS, and again, they'll pay out £85,000 per eligible person per financial institution.
Yeah, and there's also cover for insurances as well.
I know they do like debts and all sorts.
So plenty of cover out there for us. Another thing I know is that the FSCS obviously protects your money that is deposited. National Savings and Investments also offer different products. So we've talked loads in the past about premium bonds, but they do guaranteed bonds, income bonds, all sorts of different things as well. And you might think that they're protected by the FSCS, but actually they're not.
No, they are not.
However, they are backed by the government. So if you had £250,000, £500,000, whatever amount it may be, invested with National Savings and Investments, all of that money would be completely protected because it is backed by the UK government. So it's just an extra bit of peace of mind that you can have money elsewhere and it has still got that financial protection.
Yes. Nice to have the peace of mind, isn't it?
Definitely. We like to know our money is safe.
We do indeed.
So I think that's everything today on how safe is your bank. But if anyone's got any questions, feel free to get in touch.
Please do.
And with that, we've completed today's episode. We hope you have enjoyed following along with us today and taking another step closer to a financially secure future.
If you've enjoyed today's podcast, you can head over to themoneycompass.co.uk, where you can find out more information, hints and tips from today's episode. If you'd like to get more involved, share your own experiences and learn from a friendly community on a similar journey to you, why not join us in our Facebook group, The Money Compass, where we will support you in navigating your way to financial success.
Thank you for listening and see you next time.